In what's normally a busy travel season, airlines are finding themselves really struggling to recover from a COVID-19 induced slump in demand. United now joining the likes of Delta and American Airlines in announcing potential furloughs, warning its more than 36,000 employees that layoffs may be on the horizon. But terms of the airline's federal payroll grant prohibit them from doing so until October 1st. This comes as a growing list of air carriers, including United, Delta, Southwest, and JetBlue, reach agreements with the Treasury Department to access additional federal loans to try to weather the impact of this pandemic. Joining me now is Adrian Janoschik, Senior Equity Research Analyst at Berenberg. Leslie Picker also rejoining us. Adrian, thanks for joining us today.
Good morning. Thanks for having me.
So, Adrian, we're looking at the notes that you sent over. It looks like you think that investors, they need to reassess the risk that comes with airlines and also take a closer look at the business models of these airlines.
Well, the risk has changed. You know, in the last 100 days, I think any equity analyst, any equity investor started to look at industry more as a credit analyst. The conversations moved from the typical metrics that we look at, like unit revenue, unit cost, and now we're talking almost exclusively about liquidity levels and the level of cash burn on a monthly or daily basis relative to that. You know, I think that's where the conversation has shifted. But I think looking forward, what we need to look more towards is a resized industry, an industry that's a bit smaller going into 2021.
Adrian, oftentimes when you hear the conversation shift to liquidity levels and cash burn rates, that indicates a distressed industry, one that may be looking for other strategic alternatives for their businesses. Is that what you're saying the airlines need to be doing right now?
Not exactly. I mean, I think what's happening is, you know, I think in the quarter coming up, it's going to be probably the worst in aviation history. I mean, the four majors, you know, probably burning through something like 18 billion. But let's keep in mind, they've in the meantime still been able to access even commercial capital markets and raise upwards of 50 billion or more, just the same four carriers. So I think you have to think of it in one of two ways. Is it either a permanently altered industry, or are we going to look beyond the void to recovery? And what does that mean? And I would suggest looking at the balance sheets and how the capital structures of each of these companies is the way that investors are going to have to look at them.
You know, Adrian, speaking of next week, Delta reports next week. So you're saying looking at the balance sheets, but possibly discounting this quarter. So what things should we kind of drill down into in this earnings period, and what things should we look, you know, to Q3 and Q4 for as signs that either there's a recovery on the way or the slump's going to continue?
Yeah, and I think it's a great, it's an important time for the industry. The things to keep in mind, I think, are cash burn in the context of some of these backsliding in the net bookings. One of the things the industry is looking for to regenerate some of their working capital or some of the inflows from bookings, which, you know, similar to the restaurant industry you just mentioned, have started to soften a bit. But I think we need to look at our cash burn rates going down. So is Delta going to kind of go into Q3 burning less than 30 million a day? And how are they going to track towards their target of getting towards the end of December and sort of generating some cash flow, or being at least net neutral? I think those are the things to look at.
How should investors look at any additional government support that could come into this sector? You know, do you see any kind of moral hazard going on with regard to the investor base in airlines right now?
I mean, right now, in the second tranche, really, of the 25 billion available under CARES Act support, I mean, it's sort of a last resort, and you can see that. It's another thing I think we're going to look at with Delta and whether they truly intend to take that 4.6 billion in support. I would say moral hazard occurs if, you know, there's an incentive to take that aid over other commercial options. I'm not seeing that. Delta, for instance, is very active in raising liquidity in the commercial markets. They're doing very large sale and leaseback transactions with their aircraft. They're being active in increasing the revolving credit facilities. So we're seeing lots of commercial lending as well. And when that freezes up and turns to only state support, then I think you've got a moral hazard. I look at the European airlines. That's what I'm seeing a little bit more of in Europe with Lufthansa, with Air France. A lack of commercial funding options and going directly to the state as the sole source of capital.
So, Adrian, the valuations of airline stocks, they indicate that these companies are under distress. But realistically, won't we all get back on an airplane sooner or later? I mean, a flight across country takes a few hours, a drive takes a few days. So eventually, won't these stocks rebound? And what kind of horizon do you see for that?
Yeah, and I think this is where the industry debate is. I mean, I think the consensus is revolving around total industry revenue not touching 2019 levels until late in 2023, possibly a bit earlier when you're talking about the leisure segment, possibly a bit later when you're talking about business travel. It really is about comfort, customer comfort on the leisure side, and then a reopening of businesses on the business side. But I would agree. The question is the speed of that recovery and the strength of the balance sheets kind of coming out of this period. So early 2021 and late 2021, how much repair is necessary.